Every crypto story starts the same way. The moment the price goes up, everyone suddenly panics. Great! Now it's probably too late to buy. But when the chart flips downward, the panic changes shape. Wait, did I miss the top? And this loop repeats endlessly. The cycle is as old as Bitcoin itself. First comes excitement, then doubt, then fear, and finally regret. All these emotional swings are powered by one thing: uncertainty. In the past few months, Bitcoin behaved exactly as it usually does. It broke a new all-time high and then just as sharply slid back down. Somewhere between $126,000 and $18,000, the air filled with anxiety. Social media exploded with claims of a crash. Some people insisted the bull run was over. Others argued that the real rally was just beginning. But all this noise distracts from a much deeper question. Not about price, but about the structure of the market itself. Because this time, the environment is different. Interest rates are falling, liquidity is shifting between sectors, and institutions are quietly rewriting the rules of the game. We thought we understood how the cycle works. But before declaring the bull market is dead, we need to step back and look at what's truly moving the price, not what's written in the headlines. So let's get back to the real question. Has Bitcoin genuinely weakened, or are we simply watching a normal pause before the next push upward? To answer that, you need to look past social media panic and memes and instead focus on what's happening under the hood of the market. After several months of steady growth, Bitcoin suddenly started stumbling. Just a couple of weeks ago, it hit a new all-time high, and then, almost overnight, billions seemed to vanish from the market. In about 2 weeks, the price dropped roughly 15%. But here's the key. This didn't happen because people lost faith in crypto. The real cause was an overloaded futures market. More than $19 billion in leverage positions were wiped out. In simple terms, traders piled into leverage too aggressively, too quickly, and when the price moved against them, the market flushed them out. And this isn't new. The same thing happened in 2021 after Elon Musk's tweets and China's crackdown on mining. The difference today is the scale. The capital is bigger, the data is deeper, and the emotions are stronger. But that's only half the story. Around the same time, the US Federal Reserve cut interest rates again. Markets expected this to be a green light for risk assets. But then Powell hinted that further cuts were uncertain, and with just one comment, global optimism cooled down. Here's the key point. Whenever global liquidity begins to cool down, Bitcoin is the first asset to feel it. No matter how much we talk about crypto being independent, it still breathes the same air as the broader financial markets. Less money circulating means less appetite for risky assets, and that's exactly what we're seeing now. This isn't a crash, nor is it the end of the cycle. It's the market taking a breather, digesting the recent turbulence. A reset, a recalibration, a clearing out of excess. Because in today's reality, Bitcoin doesn't move solely on crowd psychology. Its rhythm is synced with global monetary policy. Every major rally in crypto starts with the same illusion, the idea that Bitcoin stands apart from banks, inflation, and central bank decisions. Look closer and you'll see the opposite. The Fed speaks and crypto listens. This year, nearly every meaningful move on Bitcoin's chart can be traced back to statements from regulators. The most recent rate cut, just 25 basis points, looked bullish on paper. But it wasn't the number that moved the market, it was Powell's tone. He hinted that the era of aggressive easing may not continue. The Fed is cautious, inflation remains stubborn, and the dollar isn't backing down. And that shifts the entire market backdrop. Traders go quiet, funds hesitate, and Bitcoin stands at a crossroads between optimism and cold realism. While everyone was obsessing over interest rates, a far more important signal slipped almost unnoticed. The Federal Reserve has officially paused its quantitative tightening program. In simple terms, the Fed stopped draining dollars out of the system. This doesn't mean we're entering an era of free money, but it does mean one thing: liquidity pressure has eased. It's not stepping on the gas, it's lifting the foot off the brake. And in financial markets, that difference is massive. Every dollar that returns into circulation eventually starts looking for a home: bonds, stocks, commodities, and ultimately, Bitcoin. When the dollar strengthens, risky assets shrink. When the dollar loosens its grip, they can finally breathe again. Even though Bitcoin is decentralized, it's still priced in dollars. And as long as the world measures wealth in USD, Bitcoin's rhythm will inevitably sync with the Fed's rhythm. But there's another part of the cycle that works by its own rules. Every 4 years, Bitcoin seems to reset its internal calendar, not because of politics or central banks, but because of code. It's the halving, a protocol event that cuts miners' rewards in half. Each time, the market treats the halving as the start of a countdown toward the next bull season. Every investor dreams of the impossible, buying exactly at the bottom and selling precisely at the top. But in reality, almost no one pulls that off. And here's the surprising part. Data shows that even those who bought Bitcoin at the worst possible moments, at the peaks of 2013, 2017, and 2021, still doubled or tripled their capital simply by holding long enough. That's the real secret. In crypto, the winner isn't the one who predicts, it's the one who endures. With time, the noise fades, emotions flatten out, and what remains is the trend. The long-term trajectory Bitcoin has shown since the day it was created. Every crash, every panic, every so-called end of the cycle becomes nothing more than a tiny wrinkle on a massive chart a year or two later. And those who didn't panic or sell at the worst moments end up becoming the fuel for the next leg up. That's how capital is built, not through lucky guesses, but through patience and strategy. So the real question today isn't whether the bull market is over or this is just a pause. If your horizon spans years rather than weeks, these swings stop mattering. Because Bitcoin isn't a sprint, it's a relay passed from one generation to the next. If you ignore the headlines and look directly at the blockchain itself, a much more interesting picture appears. The Bitcoin market is one of the rare places where you can literally see investor emotion reflected in the data. On-chain metrics clearly split holders into two groups: short-term holders, those who keep coins for less than 5 months, and long-term holders who think in years, not days. And right now, something notable is happening. Short-term holders are sitting on small profits, and that matters. When this group has only a slight gain, they don't feel pressure to sell. Market stress goes down, liquidity breathes more freely. But once their profits become too large, greed kicks in. That's when tops form. It works like a sentiment gauge. The hotter the crowd gets, the closer the reversal. In previous cycles, the pattern was identical. As soon as short-term holders felt they were making big money, they rushed to lock in gains, believing they were outsmarting the market. Meanwhile, long-term holders quietly accumulated those same coins, and the cycle repeated. This time, however, things look different. A record share of the total supply is now held by long-term holders. That means volatility softens and underlying conviction strengthens. This isn't a crowd chasing quick multiples, it's disciplined investors building positions for the long run. If you strip away emotions and look purely at the numbers, Bitcoin's situation appears far calmer than people think. The price is currently holding solidly above its 50-week moving average, a line most investors don't even pay attention to, yet historically it separates bullish phases from bearish ones. When Bitcoin stays above it, momentum usually remains intact. The current price zone, roughly between $17,000 and $117,000, has turned into a psychological battleground. Below it, buyers step in aggressively to defend their positions. Above it, sellers hesitate, unsure whether to expect continuation or consolidation. This is where optimism and fear collide head-on. Every dip within this range is being bought up faster than before. Every push upward triggers a more restrained reaction. No hysteria, no insane candles, just steady support. That's not weakness, that's maturity. Markets, driven purely by emotion, tend to rocket upward and crash downward. But when confidence and long-term thinking form the foundation, the structure changes. Price pauses, gathers strength, and continues not chaotically, but steadily. And if you zoom out and look at the chart as a whole, the overall trend still points upward. No signs of collapse, no indicators of a reversal. Yes, it's uneven, but it's still growth. If emotions drive the market, then the MVRV ratio is basically a gauge of how strong those emotions are. It's one of the most powerful on-chain indicators. It shows whether investors are currently acting greedy or, on the contrary, staying calm and patient. MVRV compares Bitcoin's current price to the average price at which people bought their coins. When the ratio is low, most holders are underwater, nobody wants to sell. When it's high, almost everyone is in profit, and the temptation to cash out grows. Historically, Bitcoin's biggest blow-off tops happened when MVRV climbed above 3. That's the zone of real euphoria. Investors feel like geniuses and start selling en masse. Bear markets, on the other hand, usually began when MVRV fell below 1, the moment of maximum fear, when strong hands quietly scoop up the asset. Right now, MVRV is sitting around 2. This means the average investor is roughly 100% in profit. Enough to feel confident, not enough to lose their mind. It's a healthy, balanced zone. And yes, theoretically, the ratio can rise further, but expecting a 5, like in the old days, is unrealistic. The market has matured, and too many people now understand how the metric works. So this time, the top might not be explosive, but slower and more mature. And that's not a downside, it's just natural evolution. If you strip out emotions and look only at the data, the picture becomes much clearer. In Bitcoin, there are always two main groups of participants, those who hold coins for weeks or months and those who hold for years. And these two groups leave the most distinct on-chain footprints. Right now, short-term holders, people who bought within the past 5 months, are sitting on a small profit. That matters, because when people aren't underwater, they have no urgent need to dump their coins. Selling pressure weakens, but if their profit grows too large, greed kicks in. That's exactly when local tops tend to form. It's like a sentiment thermometer. Overheated means a reversal is near, cool means the market can breathe normally. In past cycles, it was the short-term crowd that pushed the market into euphoria. People felt like they had outsmarted the system, locked in profits, and long-term investors quietly accumulated those coins back. The cycle repeated over and over, but this time is different. A much larger share of Bitcoin is now held by long-term holders. They're more stable, more disciplined, and they create a cushion that softens volatility. It makes the market calmer, almost too calm, unusually calm. Because when short-term greed fades, control shifts toward long-term conviction. If you put everything together, the picture looks far calmer than the headlines suggest. Bitcoin isn't collapsing, it's maturing. Cycles are stretching, volatility is shrinking, and instead of chaotic pumps, the market is leaning more on data, discipline, and long-term capital flows. Yes, the pace has slowed, but the foundation is much stronger now, and if you zoom out from weeks to years, the trend remains the same growth through maturity. Thanks for watching until the end. Your attention is already an investment in your own future. See you in the next video.